Let's see here. It's going live, and we are live. How do I do like that intro song to it?
I don't know. It's I actually really have no idea.
Yeah. All
Are
right.
you? Is this
Oh, here it
changing on
is.
your end?
All righty.
What's up, bros?
Good
What's
morning,
up?
everyone.
You guys awake?
Yeah, I've been awake for the last 3 hours. I woke up like before 5. I couldn't sleep.
I got up at 5 too.
Yeah. Woke up like at 4:30. I went to sleep like at 9.
I like threw my back out yesterday. I feel like an old man.
So did I. 2 days
And
ago.
so I had to sleep on the couch with a heating pad on my back, and it's just a sad state of affairs over here.
Nice.
So
Was it lower back, upper back?
yeah, lower back. I just wasn't thinking, and I had lifted this very awkward object and just toast. I'm very sad for just a sad state of affairs. It's never used to happen to me.
Well, I was
Yeah.
just standing and my upper back got a spasm or whatever, and then I was
Need to get back to the sauna. I need to go into the massage room at the sauna.
Just the steam room alone. I need to start doing that again. So hopefully soon.
Yeah, that's right. So I don't think our guest is showing up today, unfortunately. So it seems like it's just us three.
Hell yeah, dude.
Yeah. So maybe next time. Oh, there it is. We got Michael here. Nice. Hey, what's up, Michael?
You're live.
Good morning.
Hey guys,
How you doing, Michael?
Can you hear us?
I can hear you just fine.
Perfect. Awesome. We weren't sure if you're going to make it or not. So
No.
happy to have you here.
Happy Freight Gong Friday, if you will.
That's right.
Back at you.
So we are live right now, Michael. If you could give us a quick introduction to who you are and what you do in industry, would be great.
Yeah, sure. So my name is Michael Tanzer, and I work for CCUR Holdings. So CCUR Holdings is a private investment holding company backed by family office and institutional investors. And so while I've never actually worked in the freight and logistics industry, I've spent my entire career making investments in public and private companies. And for the last, I think, 6 or 7 years, I've been interested in making investments in part in the 3PL industry. And, I've looked at a ton of freight brokerage businesses over the last year or two. So I've been fairly close to, a number of founders, a number of businesses that are going through transitions. We have yet to do, any kind of acquisition in, the logistics space related to freight brokerage. But we're keenly interested, and I think I kind of have somewhat of a unique vantage point, having seen the inner workings and financials of a ton of different brokerages over the last couple of years as we go through this kind of brutal cycle. And I'm happy to answer more about anything about the above. I will say, just kind of a lawyer's disclaimer. I'm here, and these are all my opinions and not the opinions of for shareholders or the corporation itself. So, but yeah, that I could do that, so I can dive into the memes and the spicy takes and whatnot. Yeah.
Dude, so wait. So you guys, how long have you been looking? You've been looking at brokerages for a couple of years, and you guys haven't made an investment or an acquisition in that time. Is that just because? First of all, do I have that right?
Yeah, I mean, well, I find I said this to Paul before. It seems like basically you meet people in the brokerage industry, or maybe even logistics generally, and people get involved in the industry for two reasons. One is because their dad was in the industry, and two was because they randomly fell into it for some reason, and they basically never left. And 6 or 7 years ago, I was at a large investment fund. And by the way, sorry, I'm actually just getting over a COVID case, so my voice is a little, nasally or congested. So bear with me. Yeah, 6 or 7 years ago, I was working at a fund that was based in Connecticut. Coincidentally, actually, we shared the same office space as XBO in Connecticut. And so I saw, Brad and his kind of army of lieutenants just walking around the halls all the time, which was sort of funny and weird. And we actually made an investment in 2 contract logistics businesses. So warehousing solutions for mostly auto and consumer tech. And I started going to a bunch of, let's call it like logistics trade shows. And, by far the most charismatic and, boisterous crowd were the freight brokerage guys. So basically I was, drawn to these people because they're fun to be around and they're friendly. And at the time, there weren't too many publicly traded freight brokerage businesses. Echo Logistics was still public. Obviously, C.H. Robinson. But, you met lots of people where, there was so much that was very exciting that was going on in the private domain. And specifically with these companies that were growing a lot faster than, say, C.H. Robinson, like Mullen Transportation Group and, Arrive. And it seemed like there was this new generation of people that were doing things in this really exciting and aggressive way. And then at the same time, there was all this private equity backed interest in the space. And part of that was, that the M&A kind of economics seemed really compelling. And part of it was that, you had some huge private equity successes in the industry, a la Warburg Pincus and Coyote. And, what happens in finance, generally speaking, is if somebody makes like a shitload of money, people are like, oh, like, let me do that thing, And so, I looked at this at the time and was like, oh, wow, this is a really interesting and dynamic industry. And then, this was 2016, 2017. And then there was this like third element, which is that, all of these digital freight management, platforms, digital freight matching platforms were, raising a ton of money and basically telling all these freight brokers that they were going to go out of business. And, so it was this highly dynamic marketplace where valuations were very elevated. And there were lots of young companies doing exciting stuff. So at the time, I didn't really think to make an investment in the space. I just thought it was really interesting as a place to just look at and like get to know people. And then, I went to go work for CCUR about 2 years ago. And I had seen the craziness that happened, early on and through COVID in the brokerage space. And you got some, I think it was the second quarter or third quarter of 2022, where the data started rolling over basically. And, rates were giving way to the, massive wave of overcapacity. And I was like, finally there could be a very interesting opportunity to do something in the space. So sorry.
And so you've still been holding on, but you still haven't done anything. So you're basically just letting people bleed out, and then you're gonna jump in, right?
Well, I mean, it is one of these things where I think that you know, one of the things that makes managing a brokerage business just really, really, really hard is, you know, properly calibrating for the cyclicality in the industry. And there's just so much temptation to grow with, you know, large contract freight and, you know, hire the next class of young people to just say like, oh, in 2 years, this will be our productivity here and we'll be generating this sale. But it's really, really hard to not get bitten in the ass basically by the cycle. And, you know, at a certain point, there is a discipline that you want to see with the people that you invest with, right? It's like, can they, you know, properly manage the cycle, and can they properly basically, you know, pay attention to the financial model and, you know, have realistic expectations about, you know, what could and could not happen. And so therefore there becomes this negative selection bias, which happens where, you know, the people that need money the most are people that you don't really want to give it to, basically.
Yeah.
And then, you know, that's one side of it. And then the other side is that, you know, if you are a business that has generated cash flow through the cycle, and if you, you know, have properly managed your cost basis through the cycle, and, you know, maybe you have a good mix of, you know, specialty freight, whether that's, you know, heavy haul, drayage, whatever, stuff that's earning just, you know, more robust gross margins than, say, you know, dry van, you know, then you don't have a liquidity problem, basically. And so when, you know, you're in conversations with someone like me, you know, you might be anchored to valuations that, you know, are too high for me, and, you know, might have existed a few years ago during the bubble years, but like, you know, people get these ideas and they get anchored to certain values for their companies, and therefore there becomes this kind of, you know, bid-ask spread that becomes very difficult to surpass in order to do a transaction, essentially. Yeah. So, you know, maybe that's a little bit why we haven't done something. Yeah.
I'll accept that answer, Michael.
Michael, you also wrote on Substack here an article like a month ago or 2 months ago, right, about the freight brokerage business?
Yeah, yeah.
I'm just curious because do you run right under a pen name, or were you part of that like process writing? Because I see it's like written by James right here.
Yeah, that's yeah. So I started that little blog that I very rarely write under when I was at a prior employer that I didn't want my, you know, thoughts and names attached to in the public domain. There's no issue now. I just think it's funny to have a name, you know, a nom de plume.
Sure.
Yeah.
Love it. Yeah, and this was a great article that you put together. I mean, it's a long piece, but it was really like detailed and kind of walked through like the brokerage industry and what's going on. So yeah, I mean, this was really interesting. That's how I think we kind of got connected, because I like this. I like the post, and I think Andrew Silver.
What's it called? I want to look this up.
Yeah, I could just put the link here.
Yeah, put the link somewhere. What
in the private chat, but I could also maybe put it in the comments.
Michael, I guess I have another question, unless Paul or Christian does, because I've asked a few. No, Bueller. Okay, I'm going. Who do you think of as like the top investors in the sector? Like, who do you think does a really good job? Like, what are some, and then maybe secondarily, like, what are some, like, you know, famous deals maybe in like your sphere, like stuff that you look at, you're like, wow, that was like a home run for whoever, you know what I mean?
Yeah, it's a good question. I think probably the best couple of folks that come to mind. I know the Jordan Company, or the Jordan Companies. I can't remember how they
Yeah,
phrase
that's
it.
who took Echo private, right?
Yeah, and I know people at Echo, and so I've had a not kind of like firsthand knowledge, but I would say secondhand knowledge of how they, talk to their portfolio companies. They're really, really good. And I would say what distinguishes them, not just kind of in-depth knowledge of the sector, and I think they've had a couple of like huge home runs, but they really get the cyclicality element. And I think like, you know, when you're thinking about a typical private equity fund, private equity funds buy businesses oftentimes with a lot of debt. And so what they're trying to do is essentially, make a high return on their equity investment, oftentimes by, enhancing the earnings of their company, but in a very steady way that it doesn't negatively affect their debt relationships and covenants and stuff like that. And so it takes a lot of faith in the investment thesis and faith in the management team to say, we get what you're doing in terms of really making investments for, the long term and trying to increase the value of your enterprise, especially with something like freight brokerage, where, the investments that you're making now, if you're doing something actually really differentiated in technology, that's not going to be you're not going to see the payback on that in year one.
Mhm.
And then the other thing is sort of the dealing with the cyclicality around, hiring, right? So, if you have a highly, data analytical perspective on, okay, and there are lots of models, but let's just say you follow the model where, you're hiring a bunch of young people in kind of a class, you're educating them. You expect there to be a certain churn of those people after a certain period of time, and you expect a certain, productivity in terms of loads per broker per day. But how do you measure that, right? How do you measure that against a cycle? How do you measure that against rates? It's really hard, right? And for an outside investor to have the confidence that despite the optics of, say, the earnings going down because of cyclical concerns, that they're confident in management, that they're making the right investments to increase the value of the company in the long term. That's a very, very difficult thing to do, I think.
Mhm.
My understanding is that the Jordan Company does that quite well. And then, I mean, it goes without saying, but what Brad Jacobs did with XPO in the industry is
Mhm.
I think kind of legendary, if you will. Yeah.
Can you tell us a little bit about that, Michael? I'm curious about the XPO. Like, what did Brad Jacobs do? Because I feel like you know like a lot about what he did. Like,
I mean, he's written the whole book and he's been on a media tour, so he could probably say it better than I can. But I think what I admire about him is it's quite rare that you see someone who has had such an outstanding record of success in so many different industries. So he did it in waste management, and he did it in equipment rental, and then across logistics. But it's like logistics is not like one thing. He was massively successful in like 4 different businesses. And so when it comes to XPO, I would say there's a few things that seem quite amazing to me. One is the purchase of Conway, where at the time, I remember, I think this was 2015 or 2016, I can't remember exactly, but it looked like the world was maybe a little shaky in terms of macro issues. And, he did this transaction where he bought Conway, he kept the LTL business, he sold a truckload of assets, in kind of this counter-cyclical way. Prior to that, he went around telling the whole world that he was, doing an asset-light logistics roll-up. And then, the stock goes down almost 50% because people are like, holy crap, you're buying assets. And, it turns out that it was, the perfect timing, an amazing valuation. And then they made significant improvements to the asset over a 5-7 year time frame. So to have that flexibility of mandate and thought and make an opportunistic, probably incredible deal is amazing. They also did something which is much smaller and much smarter. They acquired this company called 3PD, which was, I think at the time, one of the only scaled last mile asset light platforms. And that today that sits in RXO. And it's just one of those things where, because it's not big in the grand scheme of things, you don't hear a lot about it. But actually it's like this quite rare asset that they bought in a very attractive price and have grown consistently since. So I would say, broadly speaking, what's sort of interesting about Brad is it's like, breadth of success, flexibility and opportunistic, and also a great track record with actually improving the assets that they acquire, and not just like buying stuff for cheap and then realizing the value. That's just offhand of what I would say about it.
Got it.
Seems like he developed the skill to do that pretty well and pretty drastically. Even
it was interesting. It was interesting listening to him launch. What's his latest one? QXO. Yeah. I mean, he basically buys the carcass of a public company and hollows it out and then just turns it into what he's trying to do. I mean, the way he goes about he's obviously a public market guy, and he just knows how to run work that system better than probably anybody, really. I mean, I don't know a whole heck of a lot about the nuances of that, but I mean, it's super interesting to listen. And he definitely has been doing a total road show. I've seen, he did a 4-part podcast with Odd Lots, I think. I haven't listened to it completely yet, but it's I mean, he's definitely. Yeah, I will say he did deny coming into the arena with me. I did DM him, but so maybe
I was gonna find the video.
Isn't big enough. Dude, we got to get him on Gong, bro.
We do.
Can we lie about our stats, and can we pad our stats and just send him a little deck or something?
So Michael, Brad was at F3 last year in Chattanooga, and there was a Q&A session. And Reed asked if Brad could sponsor Reed's Gong, and Brad responded, "Your bong?" And Reed's like, "No, my gong." And it was just such a funny.
He remembered me because I DM'd him. Yeah. I DM'd him, and I was like, "Hey,
how could you forget?
You want to sponsor the Gong?"
Yeah, how could he forget that? But somewhere in my Twitters, in my, I don't know, one of my tweets, but the video was hysterical. Definitely something Brad Jacobs wasn't expecting.
For sure.
Yeah, that was great. But okay, so curious, Michael, from your perspective, a lot of these companies that are listed as the top brokerages in the country, a lot of them are there's a lot of private equity here. I'm curious on where you've seen private equity in the last couple of years. Have you been seeing a lot of transactions occurring since you are interested in acquiring? You probably see the ends and see who's buying who. There's probably been a dip since the pandemic boom. I'm curious what you've seen. Is private equity still really interested in logistics? What has changed? And I don't know, can you maybe talk about some recent transactions that you've seen?
I'll add a footnote to this one. The Coyote deal a couple months ago.
Yeah. I mean, I think that there's been, what's funny is there was sort of an interesting, I think it was the same week or, maybe, 2 or 3 weeks prior, but, you know, NFI bought the actual brokerage unit of Transfix, but the news was almost immediately overshadowed by the RXO Coyote deal. And I think what was sort of interesting about the Transfix deal was that, you know, that was kind of the last man standing in terms of the, you know, digitally enabled brokerages or whatever you want to call them. And so in a way that was sort of an end of an era. I mean, I never really understood how anyone could run a brokerage in New York City, considering people's cost of living there and the rent you would have to pay and whatever else. But maybe that's besides the point. I would say, you know, the Coyote RXO deal is definitely a bellwether. And I would say, considering how important Coyote has been to the industry, both in terms of, you know, the legacy following from American backhaulers and, you know, the way that it kind of changed the industry's relationship to Chicago, and even the way that it you know, it used the Chicago model in such an aggressive way with private equity participation and, you know, selling out to UPS in this big deal. Like, it's just an important company in the industry, regardless of its financial place. And the fact that that is, you know, combining with RXO, I think it's just an important transaction. And what's sort of interesting is the price was, it was a fair price, but it was sort of a cheap price when you think about the potential for the asset. So it remains, obviously they haven't even closed the deal yet.
What was it? Do we know the price? I don't remember.
Yeah, it was like $1 billion.
It was a little over $1 billion, which I think was something like, you know, something like 10 or 11 times EBITDA on a trailing basis. But, you know, you could argue that the trailing earnings are suppressed because of the cycle. And then I think, you know, what I've been told is that, you know, Coyote has had a tough couple of years in terms of, you know, retaining employees and the general culture and stuff like that. And so there's an opportunity to kind of reinvigorate the franchise, I guess is what I'm saying.
Yeah.
So aside from those two big deals, there have been a few smaller deals, but really the whole deal making environment has gone, you know, has basically gone down quite a bit. And part of that is driven by the dynamics that I talked to, you know, before, which is this negative selection bias in terms of the people who need capital. And then also this kind of wide, you know, bid-ask spread for, you know, sellers and buyers, basically. I would also add that, you know, like I said before, private equity likes to acquire stuff with debt. And, you know, sometime around, you know, 5 to 10 years ago, traditionally lenders in the transportation space have focused on asset-backed financing, you know, meaning, you know, you're a carrier, you have a bunch of trucks, like we could assess the value of those trucks and we'll lend out a discount to that value, right?
Mm-hmm.
Like, that's a very easy loan to make. Then people start figuring out that, you know, on asset-light businesses like freight brokerage, you know, you can think of the value two ways. You can think of the enterprise value based on, you know, an EBITDA and a multiple to that EBITDA. And then you could think of, oh, but they actually have these receivables as well. And the receivables, the counterparty risk is actually pretty good. We could lend against those. But, and most small brokerages, you know, gain access to debt capital through leveraging their accounts receivable. When you're talking about larger brokerage businesses, in order to leverage them for a private equity transaction, most would rely on private lenders that would look at that as say, oh, your business generates, you know, $10 million of EBITDA. You know, that might make it worth $100 million. We're willing to lend, you know, $50 or $60 million against that transaction. And the problem with the freight cycle is that a lot of that EBITDA has gone away and it's really restricted the capacity of lenders to do something like that.
Mhm.
And so therefore, it's just made it a lot more difficult for private equity to get involved in the space from an acquirer perspective. Yeah.
Okay, makes sense. So basically, there's been a lot fewer deals done, and like during pandemic, a lot of private equity was like buying
Isn't
logistics companies, and now
that a pro? I mean,
down.
but like the psych isn't now like when things are the hardest, like the best time, quote unquote. It's obviously the most challenging time from like a numbers standpoint to like, you know, if you're trying to do one of these debt deals, I guess that makes sense. Maybe now is a more difficult time to get something like that done. But I mean, if you're talking about acquiring a company, is it now the time to do it?
Yeah, that's my thought, you know.
Yeah.
Yeah, and so the people that we've tried to, you know, talk to and focus on, it's not just, oh, we're giving you money to save your business. It's not just, oh, we're going to acquire your business and take out the ownership. It's, we're going to give you capital to do something and do something interesting. So whether that's, oh, you want to go buy another brokerage business and we'll finance that for you, or there's other stuff that's sort of interesting. You know, I think there's a business, you know, ITS that has been private equity owned and been hugely successful. In fact, I should have named, you know, that as, you know, one of the legendary investments, because I think at one point, you know, the sponsors that they were working with, I think took, you know, EBITDA from, you know, 10 to over 100 million in the course of a 5-year span. And the model that they followed is super interesting in that, you know, I think they use the term asset right. And, you know, it's not just brokerage. It's not just multimodal brokerage. They own assets. They have warehousing. And, you know, that model is very attractive, I think, for a number of reasons. But that also takes a lot of capital, particularly if you're adding assets. So, you know, that's a model that, you know, if we found the right partners to do, that would be super interesting for us. Yeah.
What's the biggest deal that you've done so far?
What's that?
What's the biggest deal that you've done so far in your career of investing so far, whether that's in logistics or outside of it?
Well, you know, the contract logistics business that I referred to earlier, that was sold to DP World for $1.2 billion.
Decent chunk. And what was it bought for? Sorry.
Well, we actually acquired the business with a group of investors through essentially what is a bankruptcy process. It used to be owned, prior to our involvement, it was owned by a private equity fund. They put way too much debt on the business. And, you know, they had some issues with a couple of contract implementations. So the business fell into a state of distress. What we did with a bunch of other investors was go and acquire the loans. We actually took them through an English scheme of arrangement, not a US bankruptcy process. And the lenders actually wound up owning the business with management. And then we, you know, sold, you know, years later. But our cost basis in those loans was something, let's call it, you know, 300 something million.
What does buying debt from a company declaring bankruptcy actually look like? Like what exactly is being bought there?
Well, you buy the debt, whether that's loans or bonds, and effectively what you're doing is exchanging that for new equity in the company, basically. Now, whether that happens in court or not, that's more of a process question and relates to kind of like, you know, the legal issues of the business and who holds what and whatnot. But, you know, that's the way that you could, you know, help solve the problem that way.
So are you essentially paying off their creditors?
Yeah.
And then in exchange for that, the company gives you equity at some kind of rate.
Yeah. I mean, basically you become the creditor, right? Because you go and buy the claim.
And so do you try to buy try to buy the debt at like a discount essentially, and you'd negotiate with the creditors to get, oftentimes they're probably just like wanting out. And
Precisely,
yeah.
Because usually they, loaned into this big fancy LBO thinking everything will be great, and now things are a disaster in their minds.
Yeah.
And so they just want to minimize the brain damage. And so you're coming in and saying, okay, I'll pay you, 50 cents on the dollar, and you could walk away from this mess. Yeah.
I didn't realize that it's actually an attractive acquisition for private equity to come in. I guess it kind of makes sense going in and buying like a company declaring bankruptcy and basically trying to turn it around.
I mean, isn't that like that's like the famous private equity move, right?
That's true. I'm not, as you can tell, I don't know anything about private equity.
I mean, that's like their thing. That's like their thing, basically, right? I mean, that's like what private equity essentially started as, right? Or most famously, I guess.
Well, I mean, oftentimes, yes. And a lot of the, brand name large private equity funds now do have some of their historically best investments in that space, but it represents now a pretty small. And I would also add, specific to the logistics industry, it's really difficult to execute something like that because, once you get in the realm of the distress world, counterparties abandon you very quickly with good reason, right? If you think about a brokerage, for example, oftentimes your biggest creditor is essentially the money that you owe to your carriers, right? Yeah. And as soon as the carrier world gets any whiff of distress, it's like they're gone.
Yeah, the factoring companies shut you off. I mean, you're the money dries up. I mean, freight brokerages are essentially, I mean, they're literally just like kind of like ATMs almost. Maybe that's not the right analogy, but I mean, like so much of the money that they have come in is like spoken for immediately. It's like not even their money.
Yeah, and I think that a lot of the smaller brokerage businesses that started a few years before COVID, they kind of learned the wrong lessons in terms of how asset intensive their business really is. And part of that was that they were accumulating these lines of credit based on the receivables that they were receiving and, sending the cash out the door to their carrier base as soon as possible. But then when rates go up, the market slows down, all of a sudden you're in a shitstorm, basically.
And this might be a dumb question, so forgive me if it is, but are there any brokerages that don't leverage their receivables?
Yeah, I mean, I have found a few, and I think this is it points to kind of an interesting dynamic that there are lots of brokerages out there that are fairly small, some that focus on, again, highly specialized stuff. I mean, my understanding is like the subsector that comes to mind often with this is like drayage, but turns out drayage is getting a lot more competitive. But let's say you're earning 25% load margins on the drayage business. You can actually just generate enough cash from your margin that you don't actually have to leverage your receivables. Now, one can argue that that's not an efficient use of capital and that you're just going to hold a bunch of assets on your balance sheet that you don't need to. But actually, when there's a downturn, it feels pretty good, I would imagine. Yeah. Mm-hmm. The problem is that the working capital cycle of a typical brokerage where you're getting paid by your shipper, and now the shippers are stretching their payables a little bit more, but let's just say 40, 45 days, and you're either using a factoring company or you're paying it straight off your balance sheet to your carriers, either with a quick pay option or just kind of as the terms of your agreement. in, let's just say, a third of that time. That creates this working capital drain every single month that you have to deal with. Now, that is okay if that is constant, right? Meaning, you're just generating sales every month, and you're collecting receivables that you booked last month, and you're paying out payables that you did this week, right? The problem is when you're growing very fast, because that means that your receivables balance goes up, and you still actually have to pay the payables. So you're hit with this working capital, cash flow drain. And now, if you layer on top of that you're actually creating an operational burn because you're hiring with the expectation that you're training people up to be productive in the future, you have this double effect on your cash flows. And so the issue is that, can you manage a business where, you could just finance your own working capital off your own balance sheet easily? But then the question is, how fast do you want to grow? And that's a really tough question, and it's a very difficult skill to employ, especially when you consider the cyclicality of the industry.
Have you noticed more growing debt on the balance sheets of brokerages ever since since the rates went up? I'm trying to better understand how that dynamic works. I know I think you tried explaining it, but it wasn't super clear to me. So it's if the rates go up, the debt on the balance sheet of the brokerages.
You mean interest rates or freight rates?
Interest rates, because don't the brokerages essentially act as partially kind of like a lender in a way?
Yeah, I mean, well, if you're financing your growth with debt, there's basically two ways to do it on the smaller side. And I'm not talking about specialty loans or whatever. One is you have an asset-backed facility, which basically is leaned against your receivables. And usually you have a personal guarantee and whatever else. And then the second thing is you could use a factoring facility, right? So in the case where interest rates go up, the way that your, interest expense is structured off of your, asset-based facility is that it's usually like an index rate. So, it used to be LIBOR, but now it's SOFR. SOFR plus 500 basis points, which means it's today 10 or 11%. Well, that used to be 7%, and now it's 11%. So that just makes your financing incredibly more expensive. Same thing happens on the factoring side, where if you were paying 100 to 200 basis points before on every factory invoice, which again it doesn't seem like a lot in the moment, but if your gross margin is 11% or 12%, that's like a crazy hit to your profit, especially if that profit's going down. And then the second thing is, now we're in a higher rates environment, and it went from 2% to 4% basically. And turns out your factoring company is also scared because of the state of the world, and they're less likely to accept certain receivables as whatever. So all of these forces work in kind of pro-cyclical ways, and this is kind of the nuance of the cycle that makes it just more difficult to manage through.
So from a balance sheet perspective, besides, for example, operational efficiency that could be causing a company to go bankrupt, they're not making enough margin, from the perspective of how much debt they have, that basically exacerbates the issue, especially in a
and then I would add a last part, which is kind of the miserable cherry on top. And I feel like I'm all doom and gloom here, but I'm just describing what happened, which is that a lot of these smaller brokerages over the last 5 years have scaled aggressively using the Chicago model, trying to gain these long-term partnerships with these large enterprise shippers that 60 or 70% of the freight volumes are contract rate negotiated on a 6 or 12-month basis. A lot of the brokers that I've spoke to they talk about this stuff like, oh, we're investing in a relationship, meaning they're taking crappy margins on contract freight over a period of time and basically saying like, if we do a good job next year, we'll come in and instead of the 8% margin that we're underwriting, we'll ask for 9 or 10%. And, it won't matter because we're going to be growing by then or whatever. Well, turns out that, if your whole business is shrinking and all of a sudden that, contract enterprise shipper is a substantial portion of your business and the margins don't work and you need the receivables for your asset-based revolver, like you're stuck. And, that enterprise shipper is going to be like, sucks, man. That's the market,
Yeah.
And so, in an ideal economically rational world, you would say, well, you should go find another brokerage. But because of the receivables that you need and because of the cost basis that you have in your existing payroll, you can't do that. And so a lot of brokers have found themselves in that kind of trap.
You're saying from the existing receivables that you have, like you can't leave that shipper because you need to keep collecting what they owe you?
No, it's not that. It's that you need the future sales for the receivables to come in to have your borrowing base on your line of credit, basically.
Oh, so you can't just drop your volume that's what you're getting at. Like if you drop your volume, then you won't be able to get those credit lines that you might have previously been able to get to fund those receivables.
Precisely, yeah.
Got it. Yeah, that's a sticky situation for sure. So
yeah.
Is there have you seen any do brokerages have an easy access way to like find out what the credit worthiness of a shipper is at the moment? Have you seen anything out there that's a good resource to brokerage?
Not really, but what's sort of funny and weird about this particular cycle is that like I don't just focus on the logistics industry, and I would say that generally speaking, the economy has been pretty okay. And so, it's like one of those things where people, in the investment business or otherwise, they're like, yeah, we don't see the distress in the market. It's like, well, talk to people in the freight industry, I guess. But because of that, consequence is that there hasn't been a lot of credit risk in the shipper universe. So it hasn't really been an issue.
Really?
Yeah.
I'm curious, Michael, where do you see the industry headed now? Like, are you timing like your, I guess, like, I don't know, buy-in into the industry? Are you looking like, what are you waiting for to get into the industry? And like, what do you think, like, do you think the industry in the next year or two, like, will change, the market will get better and more private equity will start coming in again? Like, what are your thoughts on that?
I don't know. I don't think anyone knows for sure. I would say that what's really interesting to me is trying to execute, an asset right strategy with brokerage as kind of the focal point, but also integrating, stuff like, transload capacity and assets maybe to and from the port and stuff like that. That's a model that I find very attractive for a number of reasons. I think the big question for the industry is that, there was this dream in a way with the digital freight matching companies that, just like, early versions of TMS software changed the relative productivity of certain industry players to cause kind of a punctuated equilibrium in terms of, productivity in brokerage businesses. There would be these advances in technology involving, algorithms that match freight or, AI or whatever that would, essentially cause another jump in productivity. And you can measure this, let's say, by loads per broker per day. And the question is like, are we going to see that, right? I don't know the answer. I'm not a technology expert, and there is some evidence that particularly with high volume contract freight, where there's a lot of repeatability in routes and a lot of predictability in routes, that you can effectively, accept, lower margins on that freight and still make it profitable, in part because of the technology tools that have been developed. And most of them are around, essentially bolt-ons to the TMS ecosystem. To what degree that can be scalable, and really you can see essentially the excess returns and scale from the industry, I think is the open question in the industry over the next 5 to 10 years. And if the answer is yes, right? If the answer is like, we're just going to see brokerages that will be able to handle massive load volumes at just a lower cost basis, essentially the investments in technology scaling, then you're going to see a lot more consolidation in the industry. Yeah.
So, obviously PE firms and venture and VCs kind of think about investing a little differently, or at least their strategies are different. Like, how do you view ventures' place in the industry, like over the last 10 years, call it, and like going forward?
Yeah, I mean, I went to a manifest a few months ago, and I think I saw you handing out those hats. I kind of wanted one. So, but it's funny because you could see all the VC people because they kind of stick out a little bit like sore thumbs, and the irony of VC involvement in the industry is that they put 90% of the capital into the companies that are now all out of business, basically, that were purporting to disrupt the industry via these DFM platforms. And at the same time, there were so many interesting things being built in terms of essentially technology layers that stack on the TMS, basically. And I think there's still a lot of dubious technology that's being built in the industry. So I would say, like, I've had so many people who are trying to develop their own TMS system and then have this delusion that they're going to sell it to other brokerages. Like, that's just never going to happen, basically. And yet I didn't say anything about media companies. That's a different story.
What about a hat company?
What about what? A hat company? No, that's terrible. Yeah. But I think that the there's still a lot of, so again, to your point, like, when things look bad, that's when you want to invest, right? I think there are lots of super interesting technology startups. People just have to actually get to know the industry and not be suckered in by like Uber for trucking, Yeah.
That ship has sailed.
Yeah. I mean, I think like what Matt Silver, for example, is building at Cargado, like if I were a VC, I would love to give him my money, for example.
Well, that's a unique take, right? Like that's a compliance efficiency, operational efficiency, where there's just a tremendous amount of like, I guess paperwork and BS that you need in order to move freight across two countries, but particularly Mexico and US, right? So, but I am definitely bullish on Cargado as well.
Yeah.
He did raise. I think he raised.
He raised twice. He raised a lot more than that, I think. But I got to get going, Michael. Unfortunately, I got to go actually visit a trucking company in Elgin, Illinois. Christian's going too. Nice. I really enjoyed this conversation, Michael. Really appreciate that you came on.
Yeah, we gotta have Michael back.
Yeah,
this is. It's actually interesting to talk to people who are like kind of adjacent to the industry in a way, who think about things a little differently, because you talk to freight brokers or whoever, or folks who are, in the weeds. It's like, I feel like they view things a little differently.
Yeah. And I will say one more thing, which is that one of the things that I've liked about the industry is everyone's so damn nice in the industry in terms of, just welcoming and, wanting to share what they're doing. And so I really appreciate the culture. And I think, you guys are a big part of that. I mean, I feel like I got a Zen addiction because of your management.
I got a Zen addiction because of Reed and Christian too.
Yeah.
Damn.
Anyway.
All right, Michael. Thank you so much.
Yeah, thanks, Michael.
We'd love to have you on again, and hope you have a great rest of your day. Hope everybody else has a good rest of Friday. Happy Friday, and we will see you all next week.
Okay.
Thanks, Mike.
Awesome.
See ya.
Take care.